History is not a random sequence of events. It is a biological cycle. It breathes in and it chokes. In the summer of 1929, 6 months before the world shattered, Joseph Kennedy, a man who built his fortune in the shadows of bootlegging and backroom deals, made a move that baffled Wall Street. While the rest of the country was borrowing money to buy stocks, intoxicated by the roaring 20s, Kennedy did the unthinkable. He stopped. He liquidated. He went to cash. When the market fell 89%, destroying the middle class and erasing generations of wealth, Kennedy didn't just survive. He made $50 million, the equivalent of nearly $1 billion today. Cut to October 1987. Paul Tudor Jones, a man obsessed with historical fractals, replicates the pattern. He senses the tremor before the earthquake. On October 19th, Black Monday, while traders on the floor were screaming and watching their careers evaporate in a 22% single-day drop, Jones made $100 million before the closing bell. Burry John Paulson. They stood alone in the dark, betting against the bedrock of the American dream, housing. They walked away with billions while the global financial system crumbled. And now, we arrive at the present. 2025. Look at the chessboard. Warren Buffett, Ray Dalio, Bill Ackman. They are currently executing the exact same 3 trades. Not 2, not 5. 3 specific mechanical moves. These are not guesses. This is not luck. This is an algorithm of survival that has played out before every major financial reset in the last century. Why? Because the anatomy of a crash never changes. The players change, the technology changes, but human psychology, greed, leverage, panic is a constant. It follows a sequence: extreme valuation, excessive leverage, a trigger, forced liquidation, and finally, total capitulation. The smart money knows the script. They know that you have a choice right now. You can be the liquidity that gets flushed out, losing 30 to 50% of your life's work. Or you can recognize where we are in the cycle. Today, I am going to declassify these 3 trades. We will autopsy 1929, 1987, and 2008 to understand the mechanics, and I will show you the undeniable evidence that the trap is already set for late 2025. The strategy begins with a paradox. To win the war, you must first abandon the battlefield. Phase 1. The recognition, trade number 1, cash conversion. The first trade is the hardest to execute psychologically. It is the cash conversion. This doesn't happen when the crash starts. It happens 12 to 18 months before, during the height of the party. It requires you to leave the table while the music is still playing and everyone else is getting rich. Let's go back to 1929. Joseph Kennedy wasn't just a speculator, he was a manipulator. He ran stock pools, artificially inflating prices to trap retail investors. He knew the game was rigged because he was one of the riggers. By early 1929, he saw the signal: margin debt. Waiters, shoeshine boys, and elevator operators were borrowing 90 cents on the dollar to buy stocks. Kennedy understood a fundamental law of physics in markets. When everyone is fully invested, there is no one left to buy. And when there are no buyers, gravity takes over. In the summer of 29, Kennedy began to sell. Quietly. Systematically. He didn't dump it all at once. That would spook the herd. He fed his shares to the eager public, converting paper profits into cold, hard cash. On September 3rd, the Dow Jones peaked. 7 weeks later, on Black Thursday, the trap snapped shut. Kennedy was sitting on the sidelines, his capital intact, watching the world burn from his office window. Now, fast forward to 1987. Paul Tudor Jones didn't rely on insider intuition, he relied on math. He saw that the market had detached from reality, up 140% in 5 years. He saw a new monster in the machine. Program trading, the grandfather of today's algorithmic trading. Jones realized that if the market dropped even slightly, these computers would automatically sell, triggering a feedback loop that humans couldn't stop. Throughout September 1987, Jones raised cash. He wrote to his investors, predicting a crash specifically in October. He wasn't guessing, he was calculating the structural breaking point. By the time Black Monday hit on October 19th, Jones had already exited the building. 2008 was no different. Warren Buffett, the oracle, sat on his hands. Between 2006 and 2007, his cash pile at Berkshire Hathaway swelled from $40 billion to $60 billion. Why? Because he couldn't find anything to buy. That is billionaire code for everything is a bubble. Which brings us to right now. 2025. Look at Warren Buffett today. He is currently sitting on $325 billion in cash. Let that number sink in. That is not just a rainy day fund. That is the GDP of a medium-sized country. It is the largest cash position in corporate history. Buffett has slashed his Apple position by 50%. He is dumping Bank of America. In his shareholder letter, he told us plainly, no attractive prices. But he is not alone. This is a coordinated exodus. Jeff Bezos sold $13 billion in Amazon stock. Mark Zuckerberg sold billions in Meta. Jamie Dimon, the CEO of JP Morgan, sold stock for the first time in his entire career. Think about that. The CEO of the world's most important bank, the man who sees the real data on credit card defaults and corporate bankruptcies before anyone else, is cashing out. This is trade number one. The insiders are handing their bags to the retail public and the passive index funds. They are raising liquidity because they know that in a crash, cash is not trash. Cash is oxygen. When the system seizes up, he who holds the cash holds the power to buy the world at a discount. They have exited the building, and they are waiting for the fire to start. But sitting in cash is dangerous in a fiat system. If the government prints money to stop the crash, your cash melts away like ice in the sun. This brings us to the second necessary move, the shield. Trade number one saves you from the fire. But trade number two saves you from the firefighters. When the system collapses, the government has only one tool, the printing press. They flood the economy with paper currency to bail out the banks. This triggers inflation, debasement, and the theft of your purchasing power. Cash is safe from the market, but it is vulnerable to the Fed. Phase 2, the fortress, trade number 2, gold accumulation. This brings us to the wealth preservation phase. The smart money knows that when faith in paper dies, history returns to the only money that cannot be printed. Gold. This trade happens in the same 12 to 24-month window as the cash exit. Rewind to 1929. Bernard Baruch, a financier who whispered in the ears of presidents, didn't just sit in cash. He converted a massive portion of his fortune into physical gold. He understood the endgame. He knew that the crash would force the government to manipulate the currency. And he was right. In 1933, President Roosevelt signed Executive Order 6102, criminalizing gold ownership for citizens and forcing them to sell it to the government at 20.67 an ounce. Then, with the stroke of a pen in 1934, Roosevelt revalued gold to $35 an ounce. He devalued the dollar by 40% overnight. Baruch, who had positioned himself legally and strategically, saw his wealth jump nearly 70% in dollar terms, while the rest of America saw their savings lose nearly half their buying power. Fast forward to 2008. While Michael Burry was betting on the collapse, John Paulson, the man who made $20 billion on the housing crash, was already looking at the next move. He knew the Federal Reserve would respond to the crisis with quantitative easing, a polite term for printing trillions of dollars. Paulson took his winnings and poured billions into gold. From 2008 to 2011, as the dollar weakened, gold tripled from $600 to $1,900 an ounce. While stock investors waited a decade to break even, gold investors multiplied their wealth in 3 years. Now, look at 2025. This is where the signal becomes deafening. We are currently witnessing the most aggressive gold accumulation in modern history. But this time, it's not just hedge fund managers, it is sovereign nations. In 2022, 2023, and 2024, global central banks bought over 3,000 tons of gold. This is the highest level of buying since 1950. China, Russia, India, Singapore, Poland. They are dumping US treasuries, government debt, and buying the barbaric metal. Why? Because they know the US debt spiral is mathematically unfixable. They know the dollar must be devalued to pay the tab. Ray Dalio now holds gold as a core position. Stanley Druckenmiller is loaded with it. Gold is trading near $4,050 an ounce, smashing record highs. This is not a bubble. This is a fire alarm. Trade 2 is active. The smart money is building the ark before the flood arrives. But preservation is defensive. For the true masters of the universe, defense is not enough. To create dynastic wealth, you must go on the offensive. You must profit from the chaos. Phase 3, the assassin. Trade number 3, the volatility bet. Trade number 3 is the profit trade. It is the act of betting on the crash itself. This usually happens 6 to 12 months before the impact. It is high risk, high reward, and requires nerves of steel. In 1929, the instrument was short selling. You borrow the stock, sell it high, wait for the crash, and buy it back for pennies. Joseph Kennedy didn't just sell his long positions, he aggressively shorted the stocks he knew were worthless. Through the summer of '29, he paid interest on those borrowed shares. He bled money for weeks. But when October hit and stocks fell 50% in days, he covered his shorts and walked away with a fortune that founded a political dynasty. Paul Tudor Jones executed the most cinematic trade 3 in history. We know this because a documentary crew was actually filming him in his office. Jones bought put options on the market. Think of a put option as fire insurance on your neighbor's house. If the house doesn't burn down, you lose your premium. But if the house burns, the insurance company pays you the full value of the home. Jones spent millions on premiums, bleeding cash as the market ground higher. His team was nervous, but Jones held the line. On Black Monday, the Dow fell 508 points. In the documentary, you see Jones on the phone, calm amidst the carnage, realizing his put options had just exploded in value. He made $100 million in a single afternoon. The big short. Michael Burry couldn't short the housing market because there was no mechanism to do it. So he convinced banks to invent one, credit default swaps, CDS. These were insurance policies on mortgage bonds. For 3 years, Burry paid premiums. His investors revolted. They sued him. They called him crazy. But Burry knew the math. When the subprime bonds went to zero, the insurance paid out 100 to 1. John Paulson did the same on a larger scale, personally netting $4 billion. The lesson? Trade 3 is painful until it is profitable. You pay for the privilege of being right when everyone else is wrong. So, where is Trade 3 in 2025? It is hiding in plain sight. The new subprime is commercial real estate, CRE. Office towers are empty, remote work is permanent, and trillions in loans are coming due at 7% or 8% interest rates, refinancing debt that was originally at 3%. The math is impossible. Hedge funds are currently buying credit default swaps on CMBS, commercial mortgage-backed securities. The cost to insure these bonds has spiked 500% since 2021. Simultaneously, we see massive institutional buying of put options on the S&P 500 expiring in late 2025. The put-call ratio is flashing warning signs. Bill Ackman is signaling another big hedge, similar to his 2020 COVID trade where he turned $27 million into $2.6 billion in 3 weeks. The trap is set. Trade 1. Cash, the exit. Trade 2. Gold, the shield. Trade 3. Volatility, the sword. These 3 trades are not random. They are a mechanical response to a biological cycle of greed and fear. But knowing the trades is only half the battle. You need to understand why they work. You need to understand the invisible mechanism that forces the crash to happen, regardless of what the news says. We need to talk about the liquidation cascade. Why does the market crash? Most people think it's because of bad news. A bank fails, a war starts, an earnings report misses. But that is a lie. That is the spark, not the fuel. The fuel is leverage, and the mechanism is forced liquidation. Phase 4. The mechanism, the anatomy of collapse. Every major financial reset follows the same 6-stage mechanical sequence. It is as predictable as gravity. Stage 1 is the bubble. Asset prices detach from reality. In 1929, it was radio stocks. In 2008, it was housing. In 2025, the Buffett indicator, the total stock market value divided by GDP, is sitting at 185%. Historic extremes. Stage 2 is euphoria. The narrative shifts. This time is different. AI changes everything. House prices never go down. Critical thinking is replaced by the fear of missing out. Stage 3 is maximum leverage. This is the fatal flaw. When prices rise, greed forces investors to borrow. Today, margin debt is near record highs. The system is stretched tight like a rubber band. Stage 4 is the trigger. This is what everyone focuses on, but it matters the least. It could be a geopolitical shock, a commercial real estate default, or a tech giant missing earnings. It doesn't matter what pricks the bubble, it only matters that the bubble is there. Stage 5 is the liquidation cascade. This is the killer. When the market drops 5%, leveraged investors get a margin call. They must sell to cover their debts. Their selling drives prices down another 5%. This triggers the next layer of margin calls. It is a death spiral. Prices do not fall because the assets are bad. They fall because the holders are forced to sell at any price to survive. Liquidity vanishes, the exits are clogged. Stage 6 is panic. The VIX spikes to 60. The news declares the end of capitalism. This is the bottom, and this is where the cycle completes itself. Phase 5, the rebirth, the implicit fourth trade. If you executed trade 1, cash, trade 2, gold, and trade 3, volatility, you arrive at the bottom not as a victim, but as a predator. You have preserved your capital, your gold has hedged against the currency response, your volatility bets have paid out massive profits. Now you execute trade number 4, the buy of a lifetime. This is the trade Joseph Kennedy made in the 1930s, snapping up real estate for pennies. This is the trade Warren Buffett made in 2008, investing $5 billion into Goldman Sachs when the world thought the bank would fail. This is the trade Bill Ackman made in March 2020, flipping his hedge profits into stocks at the absolute bottom. Trade 4 is simple. You use your preserved cash and your crash profits to buy high-quality assets when they are on sale for 50% off. You buy the despair, you buy the fear. But here is the hard truth. You cannot execute trade 4 if you are dead. If you rode the market down, if you lost 50% of your portfolio, you are paralyzed. You are praying for recovery, not hunting for opportunity. Only the ones who prepared before the crash have the capacity to act during the crash. The 2025 playbook. So, what do? Right now? You likely don't have access to institutional credit default swaps. You aren't managing billions, but you can replicate the billionaire pattern with 3 simplified steps. Step 1. Raise cash. Look at your portfolio. If you are 100% in stocks, you are driving 100 miles per hour without a seatbelt. Consider reducing your exposure. Take profits on the winners. Move 20%, 30%, maybe 40% into short-term treasuries or high-yield cash accounts. Yes, you might miss the last 5% of the rally, but you ensure you survive the 50% drop. Step 2. Build the fortress. Allocate 5% to 10% of your net worth to physical gold or a reputable gold ETF. Do not view this as an investment. View it as insurance against the Federal Reserve. When the money printer turns on to save the system, this portion of your portfolio will keep you afloat. Step 3. Buy insurance, optional. If you are sophisticated, look at long-dated put options on the S&P 500, SPY. Think of it like car insurance. You pay a small premium, 1 to 2% of your portfolio. If the market crashes, it pays out 5x or 10x, offsetting your losses in other areas. If the market doesn't crash, you lose the premium. That is the cost of peace of mind. We are currently in the 12 to 18-month window. The smart money has already moved. Buffett is out. The central banks are hedged. The volatility bets are being placed. The timeline suggests the turbulence begins in late 2025, culminating in a bottom in 2026. History is a test that the majority fails because they refuse to read the questions. They believe the party lasts forever. They believe the music never stops. But the music always stops. You have now seen the pattern. You have seen the trades. The warning has been delivered. The question is not whether the crash is coming. The question is, when the dust settles, will you be a victim of the cycle or the master of it? Position yourself accordingly.